let's kick off with this fully fed number that came in much worse than expected. It is deemed as one of those leading indicators for the second quarter reading, GDP reading in the US. It came in at 18.5, and that's down from around 36 points. Is that a worry for you? Do you look at this kind of economic data that's released on a monthly basis?
You know, I look at those figures, but one has to be very careful for these monthly figures, because there could be some factor which affected the figure negatively in this month. And therefore, I think that if we look at the overall picture of the international economy, then we're still looking at a situation where we say, but there is growth. We anticipate that the growth will continue. And I think our biggest worry is the oil price. And it's so interesting, you know, if we look at the commodity markets, we say, oh, hooray, the gold price has risen, the platinum price has risen, the coal price has risen. But oh, pity, you know, the oil price has risen. Yeah. So if we say that the oil price has declined, then we say, oh, for us in South Africa, that's actually good news. The guys in Northern Africa who are the producers of oil will say, oh no, that's not good news. But overall, I think that we must look at the impact of higher inflation, which could lead to higher interest rates, especially in Europe, where they're worried when the inflation rate is 2.7%. We would be very glad to see an inflation rate at those sort of levels. But okay, I think that if we look at the overall picture in the world economy, we say yes, there are problems in Japan because of the tsunami, and it will affect that growth rate for the next 2 quarters, I anticipate. But overall, if we look at the projections for the Japanese economy, there is going to be reconstruction and therefore also growth again. If we look at the Chinese economy, yes, they're cooling off the economy, and I think that's actually a healthy sort of trend, because we see some overheating in the Chinese economy, especially in the property market once again. So if we look at that, we say, yes, it's good that there is some calming of the strong growth that we've had last year. If we look at the European economies, of course, we see the strong growth in Germany, the poor performance of the olive belt, and we're not talking about the pig sale. So we talk about...
I like that, the olive belt. I much prefer that than the garlic and potato countries.
Okay, so we look at the olive countries and we say, yes, they are suffering because of their debt situation, and especially we see the price that they have to pay for their 10-year government bonds. You know, that is really a cost item to those economies. Yeah. And we say not good news there, but overall, positive.
So let's put it into the South African context. We had retail sales out, slightly disappointing, 5.3% relative to the revised number of around 6.3% or so. Given the fact that we've got interest rates at 30-year lows, surely we should have seen more of a boost on the retail sales front. Is there a disconnect there? Are you worried about the growth that we could see from the South African consumer going forward?
No, actually, I was quite surprised over the last year to see the strong growth in retail sales. And you know, we said World Tournament, the soccer tournament, yes, we're going to see strong retail sales, but after that, a weakening trend of retail sales. But actually, it surprised us on the upward trend in the retail sales. We see this figure of more than 5% growth, and we say, yes, it's weaker than what we anticipated. But overall, one must look at the retail environment in South Africa, given the high debt levels that we still have. And although we've seen interest rates coming down and easing the burden on households in really, you know, looking after their housing bonds and car loans and whatever, we've still seen this recovery in the retail sales, and especially we looked and then at car sales, we've seen actually a very good performance of car sales over the last year, better than what I anticipated. So if we look at that, we say, yeah, there's certain sectors which perhaps didn't do that well, but overall, I think given the high debt levels that we still have, and you know, if I was a banker, I would be reluctant to offer you extra credit if you have an 80% debt level, or more or less in that area. So with the cut in interest rates, I think it did something for the retail sales. I think it's still going to do something for the retail sales in the rest of this year. And perhaps not at the same level as what we've had last year, but we had special circumstances.
Ulrich, would you say the economic recovery that we have seen in South Africa is relatively broad-based at this point? Or do you think we still have a lot of pockets of weakness?
There are still pockets of weakness. Especially if we look at the housing market, there is surely a pocket of weakness. And I don't think that is going to disappear overnight. You know, if we look at the over-exuberance that we had before 2008, 2009, then it's going to take time to get rid of the excessive debt that we had created in this economy, but also overseas. And therefore, I think that if we look at a growth rate of around about 3.5% for this year, then I think, yes, that's actually good performance of the South African economy given these specific circumstances. We have to be careful for the inflation rate, but then, the inflation rate, the highest in 9 months.
4.1%.
4.1%. For us, it's still a good figure. Internationally, that would be said, oh goodness, this is very high. So, but if we look at this figure, then we say, yes, there are certain risk factors in line with the inflation rate. But given the weakness in certain areas of the economy, I think that our central bank will also be careful not to push interest rates too early, too fast, too high.